2024 is the year that we'll see some attention from the global funds again, because if we do get EDR sorted out within our timeline, and that coincides with the middle of the interest rate downward movement cycle in the US, I think we would attract frontier-focused funds back in.
Fixed income is going to still be like a very solid base. How you sort of plan out that to give you that solid base, and then given the market movements, how you really switch from fixed income to equity. That is also really going to make sure that your solid fixed income returns to a certain point, and then probably based on market condition, you switch to equity and then ride the equity wave.
I think things are likely to be on course. I advise investors to take that risk and be bullish on equity. We are very positive that during especially the first quarter or the first half of the year, that there is likely to be strong market returns.
On Echelon's Turning Point, we are discussing Black Swan events and equity strategy for 2024. And with us in the studio are Bimanee Meepagala. Bimanee is Chief Executive at CLSA Asset Management. Bimanee, welcome. We have Dimantha Mathew. Dimantha is Chief Research and Strategy Officer at First Capital Holdings. Great to have you here, Dimantha. And we have Nikita Tissera, who is Head of Research at NDB's Securities. Nikita, good to have you here. And here's where we'll start. We are looking forward to 2024 and beyond. We are having this discussion in late 2023, 20th of December 2023. From where you are, and I'll start with you, Bimanee, what in your view, will be the investment themes of 2024, you think?
Thanks, Shamindra. So I think 2024 definitely is going to be a very interesting year in terms of investments for us. So we feel, obviously, Sri Lanka is coming from the worst economic crisis. Slowly but surely, we are seeing some good progress being made. So we've gone through a very painful process of reforms, and we are seeing some huge, substantial improvements in the macro variables where inflation is really under control. It's at about 3.9 at the moment. And if you look at like some of the SOEs which were making large losses, for example, the Ceylon Electricity Board, which was like a big white elephant, has for the quarter made a 1.6 billion profit. So these were painful for sure, but definitely we are in the right, at least in the path. But of course, what we've seen amongst all of this is that Sri Lanka is coming in for election cycle, and technically even right now, Sri Lanka can go in for presidential and parliamentary elections as we speak, if in case we want to. So whether politics is going to be a distraction is going to be a huge concern. So of course, these painful reforms, people are not happy, masses are not happy, and the VAT is going to come in to effect from 1st of January. And more than the VAT increase of 3%, what's the huge concern is the exemptions being taken off, and the local consumption, which is about 70% of our economy, is going to take at least like going to take a toll in our view. So local consumption is going to be a concern, and politicians being politicians, whether they will get distracted with this is going to be the large concern.
So if we sort of narrow this down into themes, you're thinking distraction of politics, consumption is likely to take a hit, are likely to be the big themes. Plus, we've done some work on
the reforms process and the macro variables improving.
Dimantha, the same question to you. From where you are, what do you think are likely to be the investment themes for 2024?
We're going into an interesting year, Shamindra. So on one side, we're positive that we are going into a year where we are having slightly lower interest rates, which is a big positive. And we feel that if we can get the external debt restructuring through, we will have further positivity with possibly lower rates, maybe upgrade in country ratings. which is a key positive for alternative investment options, such as the stock market. So that said, I think there are some uncertainties as well. One key thing is the SOE restructure. Obviously, on the SOE side, we've done the easy parts, just like the raising prices and so on. But then, does Sri Lanka have the political will to do the tough reforms, the privatizations, the breaking up of the SOEs and selling stakes? Can Sri Lanka get through those? So we've not done that for the last 20, 25 years. That will be key for a sustainable economic growth going forward. And also the other factor is the uncertainty that will come from the political arena with the elections, possibly all elections that could come in the second half of the year, where you have maybe presidential, general, and local government all together. Usually that kind of uncertainty is not too great for long-term investments. So that is something to be concerned about. But obviously during the first half of the year, we think it's looking very positive at the moment.
Right. And Nikita, from where you stand, what do you think are likely to be the broad investment themes? We're looking at macro, we're looking at the economy here.
Sure. So I'll only add what's incrementally valuable. So consumption is definitely a concern, but then again, we have to keep in mind that we've come from two of our worst post-independent years. So we've been looking at a near-closed economy. We've been looking at all-time worst foreign currency, local currency depreciation. So everything was really expensive, and this, I believe, the base that we are looking at is a lot smaller than the hit in consumption that we are expecting in 2024. So I think we are looking at still, like we are from an already restricted wallet size, this the incremental VAT is it's significant. But then you're looking at, I agree with Dimantha about declining interest rates. So that's positive that we could look at. And we are looking at possibly corporates saving a very visible chunk on debt servicing. So that's one, and you are looking at a potential third tranche of the IMF coming in March. So worst case scenario, it could be stretched as much as June, but I think the worst hurdle was the second one in December. And I think the worst we've gone through, and I think even IMF expects from 2027, 50% of our debt requirements to come from market sources, and the other ones from buy and multilats. So we are looking at stable interest rates, declining interest rates, stable inflation, and private sector credit growth continuing to grow.
Help me reconcile this. Now you are somewhat cautious about the economic outlook, right? Particularly consumption, and that is, consumption is a significant portion of Sri Lanka's GDP, right? The IMF, I think, now suggests that GDP might grow by over 9% in 2024. Dimantha, can you help reconcile this? You are cautious because of the impact on consumption, and yet GDP is because of the base. How do you read this?
If you look at it from the IMF's angle and on what we look at for growth, this year, of course, we're looking at a negative 3 to 4%. And so we were looking at GDP starting to be positive, and we've recorded the first positive figure in the September quarter, and that will obviously continue to be better going forward. On the real GDP side for 2024, we are again looking at 3 to 4%, but this time positive growth. I think even the IMF has a real GDP growth of around that amount, and even the central bank, I think, is somewhere thereabouts. But obviously, the nominal GDP figures will significantly be higher with the 5% inflation that we are likely to experience. So inflation is also slightly on the upside, but it's not a big concern at the moment. So what we think is that the economy is likely to continue to recover, and on the consumption side, obviously the recovery is bound to happen, but it's going to be slightly slower, because obviously you're having further hits that are yet to materialize. Obviously, 1st of Jan, we have the VAT increase coming in, right? But however, I think the wage hikes that are likely to come in December, March, is like, we feel that it might be real wage hikes where wages actually move up and the disposable income increases. So though it's going to be slow, it will be a gradually paced out recovery is what we are looking at.
Right. I don't know how many of you look at both. You must be looking at nominal GDP, right? The amount of GDP including inflation, and then taking the forecast inflation out of it, right? How does that look for next year, for 2024, from where you are? What do you anticipate in terms of basically real nominal GDP, inflation, and then what does that translate to?
Yeah, so in terms of GDP forecast, we are also expecting around 2.5% to 3%. So obviously factoring in about a 5% inflation, it will be north of 7% is what we feel. So like what Dimantha essentially mentioned, consumption first quarter might be a bit of a concern because obviously the local consumer will have to take a toll. But of course, given the fact that the government servants' wage hikes are kicking in, and also particularly by that time, the private sector wage hikes are also going to come through. So you'll see slowly but surely consumption recovery coming from the first quarter. So in terms of broad GDP growth drivers, we are quite positive in terms of exports, because exports was not having a good time the last couple of years. So the global economy looks much better going forward to 2024, 2025. So global central bankers are running on a thin line to balance inflation and growth. So at least globally, the worst is again off. They are talking of rate cuts by the second half. So I think most particularly our apparel exports, all of that is going to support us. Tourism, I think we are doing a good job. So we can do much better. Worker remittances, particularly when the consumption is going to be tight, again, we feel that the remittances will improve, because obviously the families will tell, and that is also going to help us. So those things are going to be quite positive. And also in terms of agriculture, given the weather that we had, and obviously factoring in that we don't have any shocks coming into next year, I think agri sector is also going to be quite good. That's basically will be driving the economic numbers.
Nikita, on forecasts on nominal GDP, inflation, and then what will that translate into?
So my nominal GDP forecasts aren't too far away. So I'm looking at a real GDP growth in USD terms about slightly under 2%, maybe around 2% growth from 2024. And I think tourism is going to play a big role here, tourism and remittances. So two things that we have less control over compared to the other metrics. But compared to pre-pandemic years, tourists have to spend much fewer. They have to bring in fewer dollars in comparison to what they did earlier. I think that's a big plus. And again, I see remittances as a catalyst to turn around industries like construction, because historically we've seen increases in remittances to be a key catalyst for housing, lower middle class housing, supporting services like tiles. And we think with lower interest rates that sector could slowly turn around too. And hotels, to stay competitive, they need to refurbish more. So slow
Help me
turnaround.
reconcile this also. It's there is a tremendous amount of goodwill for Sri Lanka. I think there is. I mean, besides what the IMF is sort of giving us, the World Bank and ADB are also supporting the government's budget. There's an expectation that a lot of the foreign bilateral and multilateral donor funded projects that have been stalled now can be restarted soon after the commercial debt is restructured. What are the likely impacts of this on the economy and industry? Have you sort of looked at it in those terms? Yes, we are looking at consumption. Yes, we are looking at tourism and remittances. Those are the three things that the three of you have brought up. What about these other factors?
Such as the funding that lines that are getting available. So that is a key positive. Now, obviously, I think the budgetary support that the IMF is giving is also not going to be enough. So that's why, in order to fill in the financial gap, they've brought in the ADB and World Bank as well. So with this, I think what happens is the government gets the dollars directly, and I think what will happen is that they will look at buying dollars and releasing the rupees into the market, where the government spends in rupees. So obviously your foreign reserve component increases, while the liquidity levels, which are currently negative, may start to improve as you release rupees into the system. So that might be a very positive sign, where I think that will also help support the lower interest rate environment. And with the hits coming in, the GDP is not going to accelerate very fast. So it's going to be a very slow growth. I mean, 3% is not hyper, right? It's quite slow for a country like ours, developing country. So I think it's still likely to be 3 to 4% over the next couple of years is what we feel, because you can't really push growth, because we've gone beyond the debt-funded growth that we've seen in the last decade, right? We can't raise more debt and go into development. So that's why we are actually pro-growth, but we think it's going to be slow. That's the caution that is there, that we are telling.
Towards the year end, what do you think market interest rates will be like, and also by extension, what will be the central bank's set interest rate?
Yeah. So policy rates, we think this is the bottom, 9 to 10% SDF and SLF. And so beyond this, we think during the first quarter, government security yields are likely to bottom out somewhere in between 10 to 11% for the 1 year, to give you a range. And for the 5 year and 10 year, we're looking at 11.5 to 12.5%. That's like the range where the things will bottom out, and with the inflation slightly likely to increase towards the middle of next year, and also government pushing in with some development projects, and they've allocated a lot of funds from the budget towards development. So that's why we are having the large deficit still. So with that also kicking in, we think there could be a bit of pressure for interest rates, because the government is also competing for credit, and the private consumption is also likely to slowly gradually take pace, and credit starting to improve, because we are already seeing private sector credit growth 20 to 30 billion per month coming in. And we think private sector credit growth will end up positive this year, plus 1%. So erasing all the contractions. So next year, 7.5% private sector credit growth. So with that, we think there could be a bit of pressure for interest rates. So 1 year, we're looking at 12% by the end of next year. So which is from the bottom about a 200 basis point increase. So across the yield curve, there could be around a 200 basis point increase.
So you think they have truly bottomed out? Do you agree with that view, or is that a view you share, Bimanee?
No, I think like what Dimantha said, in terms of policy rates, we bottomed out. Of course, there is still space given the macro improvements for rates to come down. So even rates coming down to 9 to 10% is not off the cards in the immediate short term. But of course, I agree with Dimantha, given next year, latter part of next year, there could be a slight uptick, of course, a modest uptick. I mean, nothing to get excited, and not the 30s or the 20s that we saw, but maybe 13-ish, 14-ish ranges is not off the cards towards the year end next year is anyway our thinking as well.
So I think in the next 2 quarters, we definitely don't see, and central banks signal that they are not going to move the policy rates any further. But I think the 1-year bond rates could come down as much as 10%, and interest rates could come down further. I think I'm a bit more bullish on private sector credit growth. I think the private sector credit growth could be the one proxy for consumption that we are looking for, and that could drive, say, as much as 10 to 12% in the next 1 year. There is the possibility of the government crowding out the credit growth, because you're looking at a 45% increase in revenue, and the budget document wasn't exactly specific on how it's getting there. So that borrowing from the banking sector is definitely not ruled out. It's definitely in there. But one of the reasons consumption was so low in the last 2 years was there's an absolute dry out of foreign funds coming in. And now with IMF money coming in and with more multilateral help coming in our way, I think foreign liquidity being converted would solve very much our liquidity requirements. So between more foreign and domestic liquidity in the banking system and lower consumption coming in, I think we've pretty much, I think that paves way for more aggressive private sector credit growth next year.
Right. Okay. So in this context, and we are here really because we want to understand better what the opportunity in equity is in investing in Sri Lanka's listed companies, right? And one thing that any investor would be looking at right now is, okay, what's the likely profit growth in listed companies next year, earnings growth? Can I start with you, Bimanee? From where you are, what do you think will happen to earnings in 2024?
So in terms of, we don't broadly track the overall market, but based on our universe of stocks that we track, so we expect about a 20% earnings growth that is going to be there.
So you're tracking about how many stocks roughly?
So roughly about, let's say, about 40 stocks.
Okay. You're expecting about 20% earnings growth. If I can come to you with the same question, Nikita.
So in terms of looking at companies, we are still very much bottom up. But still, if we are looking at 10 to 15% earnings growth overall, maybe close, say 10 to 12% earnings growth.
Right. And Dimantha?
Basically, I would agree with Nikita. We are also looking at somewhere around 10 to 15% market earnings growth, overall market moving. So this year was slightly below our expectations, what the actual amounts that came out, especially during the first half of the year, where things were like 70% down, 65% down. So significantly lower than our expectations. So actually, we were more bullish for next year, let's say a quarter ago, but we've slightly downgraded because of the slow levels of recovery and the amounts that came out coming below expectations. So around 10 to 15% is what we are looking at.
Just to frame this conversation, in the March and June quarters, there were significant dips in overall market earnings. In, I think, September quarter, if you look at a fairly wide bunch of stocks. Earnings were up about 100%, right? Earnings had doubled in the September quarter.
Overall market earnings for the September quarter was down by 5%.
Okay, it's right. It's down. It's right.
But it is a recovery because during the first two quarters, what we saw is 65% decline and 70% decline. So 5% is like almost flat, right? So it's a serious recovery.
Right. I will ask you as Bimanee, I mean, things have unfolded and there's so many moving pieces, right, to track in the current context. If you're looking at the macro, there's so many risks and moving pieces to track. Had to do what Dimantha did, temper down or bring down what you had initially forecast. Did that happen in 2023?
Yes, definitely. We had to temper down in terms of our growth forecast for sure. But I think one of the things that central bank has also been quite, consciously doing is the inflation anchoring. I think they've been extremely successful in anchoring inflation, and the projections that they've been giving the market has been actually spot on. So that's basically a huge win. But in terms of earnings, particularly growth, and even particularly the rate at which the interest rates came down, we were expecting more of a faster, drop down in rates, which was probably, it's coming at a very slower pace. So obviously those things we had to temper down. But like what I said, inflation has been something that central bank has taken very seriously, and they've been essentially delivering on their objectives.
Right. And I think, Nikita, Bimanee brought up this point that, politics will be a distraction. From the perspective of Sri Lanka's equity market, how would you relate the political outcomes to likely equity market outcomes on earnings? We are looking at 1 year or two. You can qualify it.
Sure.
Or 2 years political outcomes versus equity market.
So one election would be tricky enough for investors, but I think we are probably looking at the possibility of having 2 elections next year. So we are the most likely case is that we are probably looking at a presidential election around say second half, maybe September, and a general election following the presidential election. So I think of all the uncertainty following the second tranche of the IMF money coming in and then March, I think the bigger uncertainty is this, because as far as the size of uncertainties go, who's leading Sri Lanka into the next phase would probably be the biggest. I think that's also one of the bigger uncertainties that's keeping the valuations depressed the way it is right now. So,
do you think that's a factor that's holding back the market?
If I start off from where Bimanee stopped, where the decline in interest rates was, let's say, slower than what we anticipated, simply because the external debt restructuring, we were sort of expecting external debt restructuring to probably be completed by, say, September, latest by November, and going into December, moving in with upgraded rating and so on. But we are at the end of the year of 2023 now. Obviously, last couple of weeks, nothing much is likely to happen with the Christmas holidays and so on. So next year, first quarter or the first month is where possibly the external debt restructuring, at least the negotiations, because the bondholder negotiations are not over, right? So that's one of the key reasons why the interest rates are holding at the current level. So that's what we believe, at least. So once that gets completed, obviously we are looking at a steep dip in interest rates, similar to what we saw when the proposals for the domestic debt restructuring were announced. And then as soon as interest rates or the government security rates drop below the overall yield curve, dropping below the 13% mark, we feel the fund flow will start towards the equity market. We've already seen this in the month of September, where most investors were selling down their bond holdings and straight away transferring money into equity portfolios. But then we've had a reverse gear with the delay in the IMF. With the delay, we saw interest rates spike up again as much as closer to 15%, the whole yield curve coming in. Now it's slightly again on a very slow downtrend with the progress that is happening on the debt front. So that slowness, it's what's dragging the uncertainty, and we're not sure for how long, but we are very hopeful, according to the conversations that are happening, that it will finish during the first quarter and there'll be a drastic drop, which will give rise to a positive outlook for equity.
And there again, to add on to what Dimantha said in terms of rates coming down and that asset allocation shift coming through, I think the taxation is going to play like a huge role, because equity is a tax positive asset class at the moment. Capital gains are tax free, whereas fixed income rates at 13 is going to be taxed at, let's say, your corporate tax bracket of 30% or individual tax bracket of 36%. So that is also going to have like a significant play. Of course, like what Dimantha said, the sentiment has to improve, and that positive news really needs to be hitting in for those movements to happen.
Let me add a bit on to that. We do say that the political uncertainty is negative for overall long-term investments. But in Sri Lanka, the run-up to elections, we've always seen a very positive returns in the equity front. There's a reason for that, obviously, because the excessive expenditure that comes from the budget. Now, compared to the last couple of years, again, you see that we are having a massive capital expenditure coming in again. And obviously, that expenditure might start to happen probably post-April, where elections are closer, which will help, obviously, again for money circulation to happen. So with that, I think, again, that will create the vibe for earnings growth as well. Lower interest rates, business activity happening, government supporting with pumping in cash with development projects. All that is positive for the equity market, possibly at least until the elections. Things are likely to be very positive for the equity market.
So, how does one approach asset allocation in this period? I mean, if you had two choices, fixed income and the market currently, what would you advise clients or ones with corporates with portfolios? How should they approach it? Should they take a short-term view? Should they consider cash? Or is there the long-term play difficult to ignore?
If you take the asset allocation, so obviously now with interest rates coming down and obviously less room to further decline, let's say after the first month or first couple of months, we would say in terms of fixed income, if you're having an allocation, probably you should start going more short term, because during the mid and long term, you'll see higher rates during those periods. So with that, I would suggest to go short term, and of course we are recommending a significantly increase in asset allocation towards the equity. So obviously a lot of people don't really put 100% to equity. They would like to have a fixed income element where you get the continuous inflow. So I would say let's bring down fixed income allocation to 40% and go bullish on equity up to around 60% in your equity or overall portfolio.
Right, because we've had sort of discussions in the past where there was a much greater sense of optimism about the outlook for earnings, and as a result, a bigger allocation for equity. It looks like reality has settled in somewhat. in the last few months, in the last couple of months, because the external debt negotiations haven't gone as smoothly as perhaps we anticipated?
So, in terms of as a fund manager, asset allocation is a very critical call, and we think anyway if the first quarter. That is, I mean, at least in the next year, both asset allocation and stock selection is going to be really critical, right? So, in terms of, I will differ with Dimantha's view. We will do like a 60-40 allocation, where 60 to fixed income, because still, like what Dimantha said, we also recommend taking bond gains in, go short term, because short terms on the money market rates are still north of 15%, and still high quality. I mean, we are not saying to go into all type of corporate debt, but high quality corporate debt, because some of the corporates are still suffering from the economic crisis. So not to go behind those, but high quality corporate debt will still give you north of 15% in terms of debentures that are coming through. So those are going to be positive. So in terms of the stock allocation decision, like what we said, we feel the local consumption is going to be a little weak. So maybe local consumer, we will not really expose ourselves too much into the local consumer side. But like what we said, we are quite positive in terms of exports and export counters because of the global recovery. And banking sector, again, we are quite cherry picking. We like banks who are really ROE focused and not really show profits only on provision reversals, but look at more core banking operations and how solid the core banking operations are. Tourism, again, the conglomerates which will be exposed to tourism, and maybe some other, again, cherry pick some of the good hotels to be invested in. So those are broadly the sectors that we will look at going forward to invest in terms of our broad asset allocation.
So if I was advising clients on multiple asset classes, which I'm not, I'm only looking at equity right now, I would have still increased the equity exposure if I was looking at it 2 months back. But I think it's the element of uncertainty and the fact that the June and September quarter earnings being below consensus was one of the bigger issues for equity. And banking being bigger portion, the quality of banking earnings has been lower because it generally came from more aggressive provisions made last year. But I think going forward, I think in the next 1 year, I would expect NIMs to be broader, interest rates are coming down, your deposits are faster to reprice, and you're looking at a wider NIMs, and I think you're looking at about 5% asset growth coming from the banking sector this year, and that will come from core. I also discussed about 10 to 12% of increase in private sector credit growth, and you're also looking at a much better asset quality going forward. So the stage 3 provisionings will be reversed. So that's a good news for asset quality going forward for banks.
Just for context, the market PE, the historic 4-quarter PE is roughly where right now?
So with the decline in earnings, the trailing PEs have significantly moved up closer to around 12 times now.
Right.
And
And when you factor in the 20% earnings that you're looking at, 1 year forward PE is...
So we are looking at somewhere around, let's say, 10 to 15%. So with that, still it's about closer to 10 times. So which is not too cheap as well. So, but I think recovery in earnings or the outlook for Sri Lanka. So let's say we've managed to get the restructuring done. So on a long-term basis, this growth is likely to be sustainable. So that will overall re-rate the market. So that is something that we are overall positive on. So I think if you take our side, we are very positive again on the banks. We think that's going to be the big thing for 2024 in the equity market. And so we are recommended to go big on the banking sector. And then the second item is, again, as Bimanee mentioned, the tourism sector, very positive. In the tourism, we are positive more on the hotels that have a large capacity of rooms, because you have a lot of a big fixed cost there. As soon as you go north of 60% to 70% of occupancy, you see a massive jump in profitability. And then finally, I would like to say we are also gradually becoming positive on the consumer stocks, maybe the liquor segment, maybe things like Hemas, where you have the consumer element. But obviously, my first two preference would be banking, tourism, and then obviously going into some amount of consumer stuff.
So you suggested roughly a 60% allocation to equity, 40% to fixed income. When you say you will go heavy into banking, Dimantha, what does that mean? Half of your equity portfolio in financial services?
Yeah, most probably half of it going into financial services. Then obviously 25% going into tourism, and then I would want to move into more blue chip counters as well, and some dividend yielding counters. So things like Chevron, CTC, those are also even foreign investor stocks where they come in big. So what I think is, once we achieve the rating upgrade, there's likely to be further increase in foreign interest. So we are already seeing some good amount of foreigners coming into the market, especially into things like John Keys Holdings, obviously, the most liquid counter. So beyond that, we think they will move into the banking sector because there's a lot more liquidity there. So that will help the overall demand of the market as well.
Bimanee, you're a little bit more conservative, at least as compared to Dimantha. You are suggesting 40% exposure to equity, and let's talk about that exposure, right? Where is the opportunity? You broadly outlined some sectors, but if you can sort of narrow it down a little bit more for us.
Right. So, I mean, like what I said, it's all about stock picking and timing the market as well. So, if you time the market well, given that you have like a solid base of fixed income returns, also getting that portfolio could generate very good returns. So given even the right now, the market is rather lackluster. I mean, things are a little, markets are a little jittery. I mean, particularly the consumption is the big theme. You've seen like, these taxes have come to the, particularly the hard liquor side, volumes are dropping, even the tax revenue is basically getting hampered. So whether those things are the right things that are basically driving, or are we driving more towards these, actually because of these sort of taxes, whether people are really going into the illicit markets, how they are going to be tackled, all of those are going to be big question marks. Having said all of that, there is still money to be made in the market, and we are quite confident that market will make good returns, and that's like what I said, it's going to be tax of, at least capital gains are going to be tax free. So there is money to be made. So like what I said, sector wise, what we are quite positive is look outside, because the local consumer is going to take a toll, at least in the first half. So maybe look outside for exports, because those are sectors which are not doing too well the last, at least the last couple of quarters. You've seen it now, particularly MGT, they've had like a good couple of quarters, and you saw the results, and the stock basically did quite well. So you should be able to cherry pick some of the export counters, because global economy is improving, the currency is expected to be modestly depreciate, so that's going to help you. So if you really cherry pick among the export counters and even banking counters, I think you'll be able to.
So help us cherry pick a few, right? There's MGT, which we saw two good quarters with, right?
Yeah.
What else in terms of exports are attractive, do you think?
So I think even MGT, you'll see the orders picking up. That stock hasn't sort of really moved up. So some of the interest rate beneficiaries now, if you look at the AWPLR from 26 is down to about 12%. So there are companies who have really geared balance sheets with good operations, obviously, will obviously have massive savings. For example, Haley's, if you look at their balance sheet, that finance cost saving is going to be huge. So those type of counters is going to be quite good. And again, they are more export based. So, it's going to be a combination of all of that, the debt saving coming through, export pickup, dollar devaluation, all of that is going to, help.
I'll throw some company names, like there's TJ, there is Heller. As far as export companies are concerned, are those also attractive? Do you think in your view?
So obviously, like what I said, I don't want to go into stock specific stuff, but I mean, broad theme or basis wise, I think export counters look quite good. But within that, I mean, within MGT, TGL and Heller, relative valuations, what you would pick is up to different.
And you also talked about picking banks that are doing, having real earnings growth versus provision reversals, which all of them, made heavy provisions in the last couple of years, right? What strikes you among the sort of banks, generally speaking, which ones are having fundamentally strong growth?
Right. So in terms of NTB, I think they've run a really unique model. So I think they've really been able to perform really great ROE. So that, I mean, it's a smaller bank, but their delivery in terms of numbers, the management focus, all of that has been excellent. So that's basically one of our, top picks. And even places like Sampath is also has relatively, strong fundamental core business that's being driven. And of course, the other thing that essentially like fund managers like us will be in the lookout of is the companies which will, banks obviously need recapitalization. So we wouldn't want to put in again for capital call. So again, that will be like a key consideration where what are the banks which will not really require capital calls in the near term. So that's also going to be a big consideration.
Nikita, in terms of, again, you outlined where the broad sectoral kind of opportunities are. Now, if you help us narrow some of those down, it's not universal, which
so
ones?
In addition to what Bimanee and Dimantha mentioned, I agree on the banking sector entirely, and NTB definitely is in terms of valuations, the most, that has the best multiples, ROE adjusted. I think that's the one bank that showed an increase in lending base last quarter compared to every other bank that grew in assets in terms of their bond holding and not so much in their actual lending. So very aggressive model, and that needs to be re-rated higher, I think, going forward. So I also agree that we need to look at exports a lot more favorably, because just like we did in 2020, 2021, we know that the local macroeconomic space isn't going to be, say, outperform the turnaround in US or EU, right? So it's very likely that in the next year, the consensus in Wall Street is that the Fed will probably cut rates twice, maybe thrice in 2024. You're probably looking at some money coming into emerging markets. So assuming that we are in a position to leverage, like if we are competitive enough to be in, to attract these funds, we need to be in either in export companies or in the banking space that has the breadth to absorb that level of frontier investments coming in from the West. So from our end, we've also made a trading call on selective plantations. So obviously, this is a highly cyclical industry, and in the past, the weather and the increasing prices have made some plantations look particularly attractive. And plantations, palm oil, companies have been the pick of plantation stocks, because they are the least labor intensive and they are the least likely to get affected whenever the minimum wage talks come in. And with all of this talk about the plantation ban probably being reversed, I think palm oil companies are in the forefront. But then again, this is not a buy and hold call. This is more of a trading play in the short term. And some of the companies, like say Namanukula or whatever, they have very healthy levels of net cash per capita. So you're looking at very sustainable dividend yield and a good defensive play.
Very quickly about tourism, do any companies strike you as being more attractive than others?
I like companies like KHL. They have, in addition to their exposure in Sri Lanka, they're present in Maldives, and even their presence in Maldives is not at resort level, but more affordable. So the turnaround from say I think this month, we are likely to outnumber the tourists coming into Maldives, but Maldives has always been a staple. So with that exposure to Maldives and in Sri Lanka, I think that's one of the better tourism exposures that you could get your hands on at very attractive valuations. I think that's one of the picks.
There was far more optimism about consumer-related stocks 6 months ago, I think, and then we've had these several shocks, from particularly with taxation, right? And
Probably a little bit more recently because of the weather-related shocks as well, with prices going up.
So it looks like suddenly they are not as much in favor as they have been 6 months ago for you. Is that the case, Dimantha?
Not really. So we've been too positive on the consumer because our GDP growth rates were anyway forecasted to be slow. I mean, 3 to 4% is not too attractive as well. So we were also more or less looking at a gradual pickup in the recovery. So in terms of that, we were more positive on the service-related counters because of that. And if you take the triangle, we were in terms of needs, we thought that food, beverage, and tobacco is where the consumer side recovery is likely to start. So obviously that will be towards the middle of this year is what we feel. So at the start right now, we think you should go big into banks. Obviously, to be more specific, we are very positive on the bigger banks, Commercial, HNB, Sampath, and of course NTB, where the NPL levels are pretty low. Actually, I forgot to mention the apparel sector Bimanee mentioned. So we are very positive on TJ and MGT as well. But with the in addition to that, with the significant reduction in price in Hela, we are currently looking at Hela as well. We think maybe towards the latter part of next year, with the US interest rates dipping and possibly the apparel segment picking up. Obviously, with the brand manufacturers like TJL and MGT, we think the apparel manufacturers like Hela also may have renewed orders. So that is another component that we are looking at. And finally, it's basically the tourism and consumer. Now, the problem with tourism obviously is in the market, the liquidity levels are not that significant. So probably if you're parking a lot of money, you may have some issues in that. But obviously banks, apparel segment, and consumer is places where you can park significant amounts of money. So in terms of consumer, to be more specific, food, beverage, and tobacco is where we are broadly positive on. Ceylon Cold Stores, Ceylon Tobacco, maybe Hemas. Those are the segments that we think we are very positive on.
Do you feel some of these sectors will outpace market-wide earnings growth? You're at 10 to 15% for market-wide earnings growth, whereas you feel banks and consumer and possibly tourism will outpace that?
Definitely. So 4 sectors, banks, the apparel and textile, tourism, and the consumer segment, consumer, also the specifically food, beverage and tobacco segment. Those 4 segments we think are going to overall drive the earnings growth.
Bimanee's Sri Lanka's market isn't always logical. Sometimes you have, good fundamentals, but still the stock doesn't move. What do you think are the catalytic events around, say, the financial services sector, consumer stocks, or even the export stocks that will jolt the market into sort of giving these companies a fair valuation?
So in terms of, I think if for a broad-based rally, I think the sentiment and the positivity sort of really needs to kick in. So let's say, for example, our first hurdle will be like a successful completion of the external debt restructuring. I think that's going to be a huge positive. And then any possible rating revision, that's also going to be positive. And obviously, like IMF reviews are going to come up in May. Along with that, the World Bank IMF funding coming through. And I think more locally driven positive news will be, let's say, right now you have like 4 or 5 who would be possible candidates for the presidential election. So I think market would be looking at really direction in terms of economic policy. Let's say candidate A, B, C, if they have the same type of sentiment and attitude to reforms and the IMF program, obviously, there could be some tweaks in terms of policy, but broadly, if in case they are in this whole framework where we are in, I think even in the run-up to the elections and even the winner, if in case broadly they are in this whole process, I think there could be like that, surprise market earnings, because like what you say, markets could be rational and, why not make that money? So I think that scenarios could be there. There could be positivity coming through, say, for example, global oil prices coming down. So yes, there is going to be VAT impact, all of that. But let's say with all of that, if there are revisions, electricity price revisions possibly will come through with this better rainfalls that we've come through. So those type of positivity kicking in, I think will, sort of build optimism and positivity, and it's all about perception, right? So sometimes markets will go ahead of earnings if the perception of things that we will deliver in 2025, 2026 is positive.
Do you think, Nikita, that the external debt restructuring and the few things that will subsequently follow an external debt restructuring will be catalytic enough to jolt the market into a valuations revision? Or are we fairly valued at what the outlook looks like?
The EDR process is one big factor, I think, with all the requirements coming in. I think the EDR by March is what IMF is expecting of us. So currently the OCC and China, that's the Exim Bank, they've agreed that China will provide all information to the rest of the creditors and be as transparent as possible. And IMF expects that we would be transparent with country creditors and the private creditors. But this will be a long process, and it's likely that we may not make it by March. So a slightly realistic target for the third tranche would be June. And if that's built into the equity consensus, I think that would re-rate the market.
As we come to the end of the discussion, right? What do you think are the black swan events that can kind of lead to a rethink? These are outliers. These are not in your sort of assessment or forecast right now. But you think there will be a big deal if they were to happen?
I'll first tell what our targets are and then go into the black swan events. So we think the ASPI, our target for this year was 12,000. Obviously, it hit around 11.8 towards September, October, and started moving down again with the delay of all the external debt restructuring. For next year, we have a target of 13,500, slightly brought down because the last year's earnings were not too great. But so obviously, we have about a significant upside, about 25% from here on. And we think the biggest catalyst is going to be the decline in interest rates. And there lies the black swan event there itself, where if the external debt restructuring for some reason gets further delayed, then we are obviously going to see a downside. Also, the other factors are SOE restructuring, because now one significant event is not sufficient right now to sustain the market, because even to sustain the economy, the reform agenda needs to continue at a stretch, because everything depends on the IMF program. So right now we are not in a stage where we can differ from the IMF, because there's not too much room for us to move about, because the economy can crash again, right? So deviations are not possible. So because of that, the continuous reform agenda should continue. Any deviation, I think, can be a black swan event. For example, the SOE restructuring not happening as targeted. Now the first quarter is where they are expecting some amount of cash or money to come in. Let's broaden the picture. If it's not the first quarter, at least the first half of the year. So that's where they will look at taking the money and funding some of the other development projects as well. So if that does not take place, that will affect everything, and possibly even the popularity in the elections as well. So then equity markets are not going to be driven positively.
Outlier events that could like derail or or sort of lead to a rapid acceleration in what we're doing. It can go either way. What do you think those are?
So, I mean, I think we broadly spoke quite a bit on the positive, so I'll just talk on the downside, really. So, one of the bigger black swan events is, given all of the taxes, this is on top of the payees, and you have the VATs coming through, whether there will be like another social unrest. So, that's going to be a huge black swan event. So, right now, it seems to be under check, but, possibly if things really get out of hand, and that's basically a concern. So the second thing is, if in case this external debt restructuring gets pushed further down, and we have to sort of keep relying on local markets, whether there would be a question whether the local debt restructuring is deep enough, whether what we did in terms of only the superannuation funds is going to be sufficient. So if that sort of uncertainty kicks in, that's going to be a huge, a concern really for all markets, because that pricing to everything becomes like a, misalignment. And the third is essentially geopolitics, how geopolitics will play. So we know US and India is going in for elections. So technically, on a positive front, we can really piggyback on India's growth. And I think they are on a really good growth trajectory. So that's going to be a positive if local corporates really sort of look at India and look at, sort of integrating or, trying to get that into the corporate earnings. I think that's going to be a huge positive. So, I mean, you see wars erupting here and there, and that having impact on our exports and even our imports, really, particularly oil. If those are going to be, beyond certain stress levels, because our reserves are still very fragile and sensitive. So whether, north of 100, 120 type of oil movement in oil prices, that's going to be a bit of a painful impact for us at the moment.
Anything you think you can add to that long list
that
we have from two of them?
I think they've covered. So I think the last two wars that have started in the last 2 years, they were absolute black swan events, and maybe, oil.
Last two wars is in Russia, Ukraine.
And Israel. Yeah. So, and
let's wrap this up, right? I'll start with you, Bimanee. Any closing thoughts as we wrap?
Yeah. So I think there is always opportunity on the table. So it's how you really read the markets, read macro. So like what I said, fixed income is going to still be like a very solid base. How you sort of plan out that to give you that solid base, and then given the market movements, how you really switch from fixed income to equity. That is also really going to, make sure that you you earn your solid fixed income returns to a certain point, and then probably based on market condition, you switch to equity and then ride the equity wave. So I think that's basically how we look at the market. And like what we said, it's going to be an interesting year and a tricky year as well. So I think asset allocation, stock selection has to be, you have to be on the ball with all of those things to really make money, because you, as much as you see positivity coming through, there is also a bit of, trigger events that could sort of, change course as well. So you got to be on the ball to see how you really sort of perfect the environment.
Dimantha, final thoughts?
We are, of course, very positive on the equity market. So I rely on the elections that are about to come, because I feel that with elections likely to come during the second half of the year, the government or the president is likely to stick course, take through the reforms. Obviously, delayed external restructuring, I think, is likely to happen, because without that, the IMF program overall will be derailed, and that will be an unpopularity signal for the government and the president. So, based on that, I think things are likely to be on course, and I advise investors to take that risk and be bullish on equity. We are very positive that during especially the first quarter or the first half of the year, that there is likely to be strong market returns.
So I think when you're looking at forward earnings, this is the most depressed the multiples have been growth adjusted for equities, obviously. And I also feel that this is the year, 2024 is the year that we'll see some attention from the global funds again, because if we do get EDR sorted out within our timeline, for me, that is June 2024, and that coincides with the middle of the interest rate downward movement cycle in the US, I think we would attract frontier-focused funds back in. And in my view, most large foreign investors haven't made money in Sri Lanka because they wait until things are quote-unquote safe here, and they move out at the closest possible site of recovery. And I think local investors should move in before that happens. I think that will happen mid next year.
All right, Nikita, Bimanee, Dimantha, this has been a super conversation. Thank you so much for joining Echelon.
Thank you for having us.
Thank you very much for inviting.